In this week's update, why I don't like the short-term signs, why the longer term still looks tremendous, and a quick check on Bitcoin. My name's Garry Davis, and as always, this is general advice only in this video, and please remember to like and subscribe to the video. Okay, I want to do something a little bit different this week. As you know, I'm long-term bullish. My basic thesis is that we're in a secular bull market that is very likely to extend through to at least 2030 and perhaps beyond. But in the short term, there are always small peaks in the market, pullbacks. We haven't had a decent correction now for well over a year, so that's probably overdue. And so I want to examine a little bit more of the short term. But let me be very clear here. I still expect that global indices will be higher by the end of this year than where they are now. But I am seeing some signs that we may be at or close to a short-term top in the market. Now, what that materializes into, we'll have to wait and see. But, you know, here is the way that I'm sort of seeing markets at the moment. First of all, there is certainly some divergence just in the last couple of days, beg your pardon, some divergence in the last couple of days between what the stock market has done and what the VIX index has done. The VIX normally goes in the inverse direction to stocks, and we've just seen the VIX, which has been falling now for a period of time, just turn up in the last few days. We're also seeing, and this is probably more important, we're also seeing divergence with great earnings results in the last few days, particularly from some of the big tech FANG stocks that came out with just absolutely amazing earnings. But you look at the price reaction, and particularly on Friday, it was pretty somber, I've got to say, considering how good the earnings were. So is this a buy the rumour, sell the fact kind of moment when the markets have run up in anticipation of great results? They got great results, they beat expectations, but the profit takers start to step in. So I think that certainly has some validity. And thirdly, and I've spoken about this very regularly, we're approaching a period of the year where the seasonality is not all that positive. Now, it's not all that clear-cut, as there's a saying out there you might have heard that sell in May and go away. That's just far too broad brush to be useful, and it just plain doesn't work in some years. But there definitely is a seasonality from the middle of May to the end of June, so about a 6-week stretch, where markets do tend to produce a relatively lower result. It could still be positive, but it tends to be a lot lower than other periods, both before it and after it. And then we tend to get a stronger July, and then we get another soft patch through August and September, and then a stronger run into the end of the year. That's how the normal seasonality sort of works. But let's take a look at a couple of these things to start with. I'll start first of all with the VIX. So that is the VIX chart on a yearly basis. So you can see we were trading up into the 40s on a couple of occasions. The middle of last year, again in October, and we had further spikes at the end of January of this year, and then a few more smaller peaks. But all the while, the VIX was getting lower and lower, and we got down to the 16s. But you can see we've had a blip up in the last couple of days. And let's go in and look at that a little more closely, and you can see it more clearly there. So whilst we've had a tremendous earnings season, it's the best earnings season that I can remember in recent years, the VIX bottomed out on the 16th of April, and since then it has been trending higher. Now, it's not a lot higher. It's gone from 16 to 18.5. But nevertheless, that's the trend, and it's unusual that it coincides with so many great results. Now let's look at some of those results. This is Amazon. And these are sort of the, some of the signs of a short-term top where you get a tremendous earnings result, but you don't get follow-through. You can see what's happened in the last 2 days. We gapped up on Thursday, closed down. We gapped up again on Friday, tested a long-term double top, and then came all the way back down again and basically closed right on the lows. And that was despite the fact that in quarter one, Amazon profits trebled to $8.1 billion. Revenues were above $100 billion for the second straight quarter. And beyond that, so it's not like we've reached the end of the line, beyond that, the company is forecasting sales of between 110 and 116 billion for the next quarter, which was also well above market expectations. So all of this is, these percentage gains are not relative to a soft period in the first quarter of last year. These results are beating estimates that were formed only just a week or two ago by analysts. And almost 50%, remember Amazon back in the early days, it was a company that sold books online. Well, now almost 50% of their income comes from their cloud services division. So how this company has changed over the years. So that was Amazon. Let's look at Apple. Second quarter earnings, $1.40 versus an estimate of 98 cents. That is an unbelievable beat. And again, that's not compared to last year. That is compared to what analysts expected no more than a week ago. Revenues were up 54% to nearly $90 billion, and that compared with a $77 billion estimate. They raised their dividend by 7%. They've got a 90 billion increase in the share repurchase plan. So they've got an existing share buyback plan. They increased it by another $90 billion. And they're showing double-digit growth in every product category. I mean, these are incredibly strong results for the long term. Yet look at the market reaction. On Thursday, we gapped higher, but then we traded down and closed on the lows. Same thing again on Friday. So, this is a really soft response from the market. And when you see this sort of thing, when you get great earnings results and the market sells off, then, you've got to take note of it. Facebook, quarterly revenue was up 48% to $26 billion. Net income almost doubled to $9.5 billion. And if you look at their advertising sales for business, there was a 30% rise in the average price per ad. That's a tremendous indicator for the future, and a 12% gain in the number of ads. And again, look at the great result. The market initially really enthused about it, but look at Friday. It's a bit like a wet blanket. So, that's when I see that sort of thing, it makes me very cautious. And then when I couple that with the VIX index turning up against all these great results that we're seeing, and it's not just the tech stocks, it's across the board. We're seeing tremendous results. So that makes me, that just makes me a little bit nervous, and why I'm highlighting it so much this week. So the immediate reaction, if we look at it on a sector by sector basis, so this is in basically within the 24 hours following the earnings announcement. Energy was the best, so that meant that the market responded the best to the earnings result, and technology was the worst. And as you've just seen, there was a tendency to gap higher and then reverse. So these are all signs of a short-term top in the market. Now prices follow earnings longer term, however. That's the key point that we've got to remember for the longer term. Short term, who knows, because perceptions flick backwards and forwards, sometimes almost on an hourly basis, based on what the Fed might say or what some widely followed analyst might say. So those things are always changing backwards and forwards, and traders take profits based on those sort of perceptions. It's unpredictable, and if you're a shorter term trader, the only way to go with that, it's not about fundamentals, it's about reading the charts and just using the probabilities. But earnings results and the outlooks are what drive prices in the longer term, and they are the strongest in many years. Plus, we've got this environment that's just highly supportive. The Fed reiterated through the week that there's going to be no change in policy from their perspective. So it's really difficult to see why the market won't be higher, and quite possibly significantly higher by the end of the year. It's just the short term that is sort of exercising my mind at the moment. So the FANG stocks, you can throw in Microsoft there as well, and Google. They had great results. They've been strong, and almost universally they're well beyond expectations. Now, last week I did speak a lot about portfolio balance, holding less of the story stocks, the stocks that you can get really excited about because it's just miles and miles of blue sky. And there are a lot of them out there, and many of them are going to achieve that blue sky. But there's a long way to go for most of them. So what I spoke about last week was holding less of those sort of stocks and more of what's trending now, because those story stocks might take years to give you a payoff. And I divided it up into 3 different categories: large cap megatrend stocks and or ETFs that are trending higher now. And there were a few other variations in there which I talked about in Portfolio Analyst. The second bucket is stocks that have got very large potential upside and limited downside from here. So in other words, the prices are not moving at the moment, but they're probably close to a base, based both on fundamentals and technical considerations. And then the third bucket is really early stage stocks that have got this massive potential, but they're not trending now. And where the price is, there could be meaningful downside before things start heading up again. So I've started thinking differently about my portfolio and encouraging the members of my services to think differently about their portfolios. Because at the end of the day, we don't make money because we own a stock that's got great fundamentals. We make money because the price moves. And therefore you want to have more in your portfolio of what is actually working now. All right, let's just check in on a couple of other things. I just want to wave the flag a little bit on Portfolio Analyst, but I'll come back to that. So if we just look at Bitcoin, so this is what I did last week. I postulating that we'd broken support, which we did last week, and could Bitcoin or should Bitcoin at least come down and test this sort of area here between the 50% and the 38.2% retracement levels, which correspond to around $37,000 and about $44,000. Now, we've had a dip, we've had a false break of support in the short term, and we've rallied. Nothing unusual about that. Many indices and stocks do that, and then may form a lower high and then complete an ABC correction. So this leg down is the A leg. This is the B leg, the counter-cyclical leg back up again, driven by the people that just believe the party's going to continue forever. And then reality sets in again, and we get the C leg, which completes the corrective phase. Now, I'm not saying that will happen, but it's a possibility. And the reason that it's a possibility is that we broke this swing low. So for the first time, we broke a swing low here. Now, if this rally runs out of steam and forms a lower peak and starts to roll over, then there's every chance that we could come back down and test this area here. So for those of you that are active in Bitcoin, just don't get carried away with the hype that's out there, unless of course you're just a very long-term holder. All right, if I may just wave the flag a little bit on Portfolio Analyst, because right now is where the majority of people need as much support as they can get and as much perspective on what the market is doing as you can get, because it's not beyond the realms of possibility that we could, I beg your pardon, that we could see a 10% plus correction in the market. Now, again, that's just not a prediction. It's just an observation that we haven't had one of those for a long period of time. It's pretty much overdue, and it's at least possible. And if you're involved in a lot of high growth, high volatility stocks, that could be really nasty. So I think getting as much support and perspective and assistance as possible is really vital in this time of the year. So what Portfolio Analyst provides is a whole lot of great buying ideas from the group. So it's not only me putting my thoughts into and stock recommendations into the mix. There's all the members of the group are raising stocks that in some cases I've never heard of until I've done the research and discovered a real gem, a real small cap gem. So that's been a huge bonus, and we've had some terrific ones just in recent weeks that have paid off big time. So I think that's a real bonus. The second area is some real market savvy education in Portfolio Analyst on both technical analysis and fundamental analysis. These are the aspects that really give you an edge in the market. Learning about things like trend lines and moving averages is, it's all mildly interesting, but it's not going to make you money per se. Where you make your money is in understanding how and why prices move. What do the big money players do, and how can we benefit from understanding what they do? And so there's a lot of that sort of real market savvy education in Portfolio Analyst. Strategy and market timing, of course, is there every week, and now is the most critical time for those sorts of things. I think all of this leads to and the ability to get questions answered about your specific portfolio stocks, both fundamentally and technically, gives members a greater confidence in what they're doing. And there's also a lot in there around risk management as well. So I think for a princely investment of $1 for a 2-week trial, I think there's an enormous amount of benefit that can be provided if you haven't tried it. All right, let's turn now to American stocks. The S&P basically unchanged for the week, went up by 1 point, and I've covered all these somewhat uncomfortable short-term divergences that I'm seeing in the market. And look, it would be unusual not to get some sort of pullback. The market has run, as we'll see on the index, has run a fair way. It's probably done it a bit too quickly. It's got a bit ahead of itself. We've now got seasonality in our favour. We've got these other indicators. The one that bothers me the most is the negative divergence between the terrific earnings results and the intraday sell-offs that we saw on Thursday and Friday. Offsetting that, Fed policy remains firmly unchanged. The CPI, I think, it came in at about 6.4, which is tremendous. Inflation is still not raising its head. The 10-year yield has stayed pretty steady. So it's really a pretty good environment for stocks, and yet we did see this profit taking. Now, the US dollar jumped a bit, so it reversed on Friday, back up to 91.3. The 10-year yield did edge up slightly from the 1.5s back into the low 1.6s, and the VIX lifted up to 18.6, as I had already covered. So let's take a look at some of the US indices. Okay, this is the daily, so you can see we really did have a big surge from the last little pullback. We had a bit of a pullback in March, and it surged, got well ahead of the 20-day moving average, the green line, and now we're just getting a little bit of a rolling over pattern. Now, what I've just spoken about may not come to pass, or we may just go, sort of sideways to slightly down. But I just think it's better to be forewarned and forearmed and give you a chance to think about how you might respond to a correction in the market if it were to occur. So that's the S&P. It really hasn't rolled over much at all, if any, because some parts of it, like the finance sector, for instance, consumer discretionary, we've got some very, very strong sectors within the S&P, so that's sort of holding it up. But if we look at the Nasdaq, not so obvious on the Nasdaq, but certainly more obvious when you look at individual sectors, individual industry groups, and individual stocks. It's a lot more obvious on the Nasdaq. And if we look at the Russell also too, you can see reasonably negative on Thursday and Friday in particular, and despite some tremendous earnings. I think something like 86% of the S&P stocks that have reported so far have beaten estimates, and that's I don't remember a number that high. So these are all very strong indicators for the medium to longer term. There's the US dollar. So we were in uptrend. We then formed a lower low, which broke the uptrend. Now, Friday we turned around, but it's only one day. So let's see how that pans out. So far we've formed a lower low. We need more information to see where we go from here. And the Australian dollar is just reflecting that. So we finished down at 76.5 on the Australian dollar. All right, while I'm here, I'll just check in on the ASX 200. So you can see we came off on Friday, and I guess that was probably in part overseas institutions front-running what they intended to do in the US on Friday night, which was sell from the opening bell. And often the Australian market is where they hedge their bets in advance. So that was probably why we were negative on Friday. So it's very hard to predict what will happen in our market on Monday. So just to wrap it up, Australian dollar down to 76.65. Our index was down 35 points. And I just want to reinforce this point again, because I know there's an awful lot of chatter out there. There's lots of websites and social media sites that are talking about these terrific growth stories that we've got, very early stage stories. I really encourage you not to fill up your portfolio with a whole raft of these great story stocks. It's really easy to do. There's such exciting stories, and you can really envisage enormous percentage gains in the future. And it's easy just to pick up all the bright shiny objects that are lying on the table. But if you fill your portfolio full of those, then the reality is that many of them are going to take years to reach commercialization. And I'll show you a chart that I showed last week or the week before that you've just got to bear in mind. It's the typical cycle of what happens with early stage stocks, and these can be in the mining area, it can be in technology, it can be in healthcare, it can be in all sorts of areas. The prices can run well ahead of the reality just based on momentum and hype in the market, and then reality sets in and the price can come way back down again as the company moves towards its commercialization milestones. So please try and remember this price chart, and that's why if you fill your portfolio up with these sort of great story stocks, then there's going to be periods that are going to become very uncomfortable. So portfolio balance is really, really important. Turning now to precious metals, gold was slightly lower, down to $17.70. It was only a couple of dollars, and silver also just slipped below 26. But if we look at GDX, it's a bit of a confusing picture. It remains in an uptrend channel, but it is testing vital support, which really does need to hold. Otherwise, we're about to form a lower swing low in GDX, which is not what I want to see. So let's just take a look at those couple of charts. So first of all, silver. Sorry, that's not silver, that's silver. So we're still just basically grinding sideways in silver as we have done since around August of last year. And if you look at gold, you can see not much change really in the last couple of weeks, and viewed on a weekly chart, we're still holding this support of the 38.2% level around 1690. And we've done a bit of a bounce from there, but nothing terribly enthusiastic. So to me, gold is just sort of in the middle of a limbo period, if you like. If we look at GDX, so GDX we've got higher highs and higher lows. So no question that we now have an uptrend, but we've now pulled back to this previous peak that was formed in the middle of March. And this really does need to hold. You know, I really don't want to see the GDX sort of down here. Wouldn't be a total disaster, but it's not really what I want to see in a strong uptrend. And certainly, if it broke this level down here, then I would be, quite concerned about where gold stocks were going. So this is one to watch quite closely. All right, other commodities, copper rose further, almost up to $4.50 now, and nickel also bounced back even harder. It had been a little bit weak over the last few weeks, but it bounced back to $7.82, and there's really no change to what is a very robust outlook. Local small caps in Australia, particularly copper stocks and some of the nickel stocks, are really roaring at the moment. And again, I just refer back to that price cycle chart. Just be very careful about getting too many of these really early stage stocks that are trending higher. Crude oil, West Texas Intermediate crude was lower. It was actually higher. I think that is incorrect. So I think it actually edged up to 63.5. The last week or the week before, I showed the sector stocks, XLE, had formed a lower low, but it's turned out, as we saw with Bitcoin, to at least at this stage be a false breakdown, and it's reversed back up again quite strongly. So energy stocks had a better week. There's the spot copper chart, so you can see we're up almost to $4.50, and that's the highest price that we've seen in a year. And there's the nickel price also. It had come off a bit, but showing greater strength now. So wrapping things up, when markets get a bit wobbly, clarity around your process is absolutely vital. And you can gain a lot of benefit by just contemplating how you'd respond to a 5 or 10% pullback in the market indices, which might mean a 20 or 25% pullback in some of your holdings. So just have a think about how comfortable you're going to feel with that and how you would respond if that were to occur. You know, and it's a very individual thing. If you're fine with volatility, as some people are, long-term holders, don't worry about the shorter-term volatility too much, then you don't need to do anything. But in my experience, and I've been doing this a long, long time, the majority of people are not truly comfortable with volatility. They say they are before the event, but in the middle of the event, they get cold feet and sell out at almost exactly the wrong time. So you need to think about who you really are as a trader and investor. And if you're a bit shaky with volatility, then you need to consider, how your portfolio is sitting at the moment. Now, Portfolio Analyst last week was very much about the focus on portfolio balance. Let's get more of what's working now and less of what is not necessarily trending now. So let's take advantage of the situation that we find ourselves in, where we've got this amazing stimulus and extremely supportive conditions for markets. I also presented a broad range of stocks that are either trending now or breaking out in Australia and in America. So I think there was a lot of value there, and also an overview of just how to use the service and how to get the best out of the the various parts, the education, the market perspective, and reviewed the 4 portfolios that we've got running in Portfolio Analyst. So that's it for this week. For anyone that wants more information, there's the website and my email address. And again, just a reminder with Portfolio Analyst, if you haven't tried it yet, it's $1 for a 2-week trial. You've got access to more than 3 years of archives of videos. I think there's a tremendous amount of benefit in there, so I'd encourage you to give it a try. That's it for this week. Cheers.